Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of business and finance. But today we are going to talk about Invest Green Acquisition Corporation's IPO. Because let me tell you, this company is aiming for a big impact in the green energy space, and frankly their setup is pretty interesting to say the least. So Invest Green Acquisition Corporation is essentially a blank check company, a SPAC, you could call it. Their main goal is to find a company in the renewable energy, sustainable finance or nuclear energy sectors to merge with. Essentially they are a financial vehicle looking for a business to take public. This fill-in gives us a peek into how they plan to do that and what kind of companies they are targeting. They are looking to raise about $200 million through this offering with an option to raise more if needed. And what you get for your money is a unit, which is one share of the company, and one right to get a fraction of a share later on. Their focus is on companies that are really pushing the boundaries in clean energy and sustainable solutions. They believe these areas are crucial for the global energy transition, making their mission pretty clear. Let's dive into some of the numbers right away, because that's where the real story often is. They haven't really operated much yet, so the financials are pretty basic, but they show us how they are funding this initial setup. The company reported a net loss of $16,682 as of June 2025. This is pretty standard for a new company like this that is still in its setup phase. They haven't started making money yet, but they do have some cash on hand. They had only $25,000 in cash as of June 2025. That seems very small, but remember, most of the money from the IPO is going into a trust account. You can't just spend that money until they actually find and complete a business combination. Also notice this promissory note to a related party for $10,420. This just shows how they are covering initial small operational costs before the IPO money comes in. Now let's talk about risks, because this is a SPAC, and with SPACs there are always risks to consider. They're very upfront about a lot of these. For example, you might not get to vote on their future business combination. And even if there is a vote, their initial shareholders might vote in favor, regardless of what everyone else wants. This means you could end up in a deal you don't agree with. A big point of discussion here is the price their sponsor paid for founder shares, which was a tiny amount, around $0.003 per share. This means their sponsor could make a huge profit even if the company's value drops after the merger, which is a classic SPAC concern, creating potential conflicts of interest. And here's a critical point for investors. Your main way to influence your investment is mostly by redeeming your shares for cash. This means you might only get your money back if you don't like the deal they eventually make. There's also the risk that their shares might not get listed on NASDAQ or could be delisted later, which would make it hard to trade them, but they seem confident in meeting those initial listing requirements. Let's look at the people behind Invest Green. Their CEO, Andrew McLean, has a strong background in sustainable finance, and even hosted a TV show about green innovation. Their CFO, Jim Campbell, comes from the investment banking world, and their Chief Business Development Officer, Michael Krawchuk, also has a solid financial and investment background. They've also brought in some pretty impressive independent director nominees and advisors with deep experience in energy and finance. Andrew McLean sounds like a really experienced guy, 25 years in sustainable finance, and he even moderated a UN Environment Program Finance Initiative Global Roundtable. That's a pretty high-profile gig, demonstrating a strong network in the green finance world. Eric Luo is expected to be the chairman of the board, and he's got deep ties to renewable energy companies like LONGi Green Energy Technology, a major player in the solar industry. He also has experience in public company governance, serving on the board of SES AI Corporation, a battery developer. So what are they looking for in a company to merge with? They want companies that leverage their team's expertise, are at an inflection point, have scalable growth opportunities, are public market ready, align with industry trends, and offer good risk-adjusted returns. They're particularly interested in rare earth materials and nuclear energy. These are definitely hot sectors for the future. The rare earth market is expected to grow significantly, reaching $16.1 billion by 2034, driven by electric vehicles and green tech. They see a lot of potential here. But nuclear energy is seen as a reliable, low-carbon option, with the market size expected to grow too, with government support generally backing these projects. Now let's talk about dilution, because that's a big deal for new investors, especially with SPACs. The founder shares were bought at a very low price. So when they convert into regular shares, it will likely dilute existing shareholders significantly. Look at the table for dilution. For example, if we look at the dilution table, you can see that in some scenarios, the dilution to public shareholders can be as high as 98.5%. This is a massive number and highlights how much the initial shareholders might benefit compared to new investors. Indeed, the report says our sponsor is likely to make a substantial profit, even if the business combination causes the stock price to drop. This emphasizes the importance of understanding the sponsor's incentives. Look at the table for capitalization. Test their capitalization table. As of June 2025 shows very limited actual equity on the books before the IPO, and almost all of it is in Class B founder shares. This is typical for a SPAC, but it's important to see the structure before the money comes in. Even the auditor's report flags a big issue. They explicitly mention substantial doubt about the company's ability to continue as a going concern without the IPO. This is a serious warning sign showing how critical this offering is for their survival. Their cash flow statement for the period ending June 2025 shows they essentially used borrowed money to cover their minimal expenses. This is normal before an IPO, but it underscores their reliance on this funding round. Let's circle back to risks because they are numerous. The company might not find any business to merge with within the 24-month time frame common for SPACs. If that happens, the money in the trust account is returned to shareholders and the rights they hold expire worthless. So there's a real possibility investors get their initial investment but without any potential upside. And remember, their sponsor and management team have waived their redemption rights. This means they are committed to the deal and won't be cashing out if things look shaky, unlike the public shareholders who can redeem. The company's legal structure in the Cayman Islands also comes with its own set of rules, which can sometimes make it harder for shareholders to protect their rights compared to US companies. So here's my quick take on Invest Green Acquisition Corporation. They're aiming for a really important and growing sector, clean energy and nuclear power. The team has some serious experience, which is a big plus, but like most SPACs, there's a significant amount of risk involved. The dilution from founder shares is substantial, and the uncertainty around finding a suitable business combination within their timeframe is always present. Investors are essentially betting on the management's ability to execute a good deal and the future growth of a company they haven't even picked yet. It's a high-risk, high-reward situation typical of the SPAC world. If they can find a strong company in the clean energy space and manage the integration well, they could do very well, but the path there is definitely not guaranteed. The auditor's going concern warning is a major red flag that cannot be ignored here. Alright, that's our breakdown of Invest Green Acquisition Corporation's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.